Hey everyone, and welcome back to another video for today. We have to talk about Amazon. Amazon is a very interesting case to study because Amazon is a tremendous company, yet a tremendous company has underperformed the market by quite a lot. Over the past 5 years, the stock is only up 41%. So it's underperforming the S&P, it's underperforming the Nasdaq, and of course it is underperforming its peers. Now, Amazon right now is a company worth $2.37 trillion. Trailing PE looks much better today than it was before. It sits at 33.9 times and a forward one of 32.1 times. Now, Amazon is my second largest holding in the retirement portfolio behind Meta. Meta is number one. Amazon was number one for a long period of time. Meta is number one because I loaded the boat back in 2022. Then it's Mercado Libre, Tesla, and I own even more Google in that portfolio. I've been owning Amazon since 2018, since the first trade war with China. And so in today's video, I do want to touch on the Amazon business, right? It's of course a business and a name that we know very well, but I do want to touch on the, underperforming part of it and where I see it going from here. So if you're interested in that, hit all the buttons. We'd really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. And also special thanks to fiscal.ai for sponsoring this video. Everything you see here, every piece of information comes from fiscal.ai. There is a link down in the description and in the pinned comment. You'd get 15% off if you use my link. New users will get Fiscal Pro for 2 weeks for free, so you can try it out. Now, of course, when we talk about Amazon, either we think about the online stores only, right? Because that's the biggest segment over the last 12 months that has generated $255.8 billion in revenue, and that's growing still 8%, 7% or so year over year. Or when we think about Amazon, especially as investors, we think about AWS. And AWS is a business that is generating or has generated $116.3 billion over the last 12 months, and that's growing 18% year over year. AWS is still number one when you look at AWS, Azure, Google Cloud, Alibaba Cloud. But AWS is also the one that is not growing as fast as the others. And that has been one of the issues around the stock and maybe around Andy Jassy as well, is that the messaging behind this doesn't make much sense. Right, we see CapEx increase, we see all of your competitors grow and increase CapEx as well. So why aren't we seeing this with AWS? Or why aren't we seeing it with AWS just yet? Well, first of all, the size of the business is different. Right, the dollar amount that AWS is adding is of course much bigger than the others. But still, there is a question about, okay, growth rates. Why have the growth rates not been like Azure and Google Cloud? Okay, Google Cloud is much smaller, which is also why margins for Google Cloud are lower than AWS. For example, AWS last quarter, operating margin here of 33%. Quarter before that was closer to 40%, 39% or so. So, of course, a huge difference between an AWS and a Google Cloud right now. But as I've shown you time and time again with Google Cloud, that is going up and to the right while Google Cloud becomes bigger and bigger. Now, the thing here is with AWS is that growth is expected to reaccelerate. If we go and look at a semi-analysis post here, they look at AWS year-over-year growth on a constant currency basis and the forecasted growth. So they do forecast that growth is about to accelerate. And when you have such an acceleration of such a huge dollar amount, well, things are going to get very interesting for Amazon and AWS's business. The first catalyst here is Anthropic's first AWS gigawatt scale cluster that will begin operations. And then we have the second one, which is basically for the next quarter. Second AWS gigawatt cluster begins operations. It's a bit like the Oracle OpenAI or maybe also Azure OpenAI combination. And so yes, while right now we are only growing 18% year over year, it's a business that generates $116.3 billion per year, but it's only growing 18%, right? What happens when we suddenly start growing 20% year over year? This is going to become an even better money-making machine that's also very profitable. And then And then I do think you're going to see the business, especially at the bottom line, start to change completely. Now, like I said at the start, it's not just AWS. If we do look at the fastest growing businesses, which are also higher margins, and here I am excluding AWS because we just talked about it, but I am showing you the comparison. This type of green here, that's the online stores. All the rest, third-party seller services, advertising, subscription services, are faster growing segments that are also higher margins. And as you can see, over the past 5 years or so, these businesses have grown faster than online stores. Growing faster, higher margins, which means that Amazon turns into a more profitable business. I don't see this changing anytime soon. If we actually go and look at, for example, the advertising and the subscription business, first up, subscription. Amazon has more than 200 million global Prime members, with the most recent data indicating over 240 million members by mid-2025. And according to some estimates in the United States alone, that's between 180 to 197, maybe right now already 200 million members, just United States. I still think that Amazon Prime is the best subscription in the market. You get, of course, good deals on Amazon, you get super fast shipping, and then, of course, you get the Amazon Prime Video entertainment. Yes, different locations, different prices, different services. For example, in Belgium, I barely pay anything for Amazon Prime because, of course, I'm not getting the same service as you're getting in the United States, for example. But I do think that as they add more value, the subscription price will go up. And if the value goes up, why would I unsubscribe? Just doesn't make much sense. Then, if we look at the advertising business, this is Amazon, the yellow bar right here. Over the past couple of years, that has grown at a compound annual growth rate of 33.2%. YouTube ads has grown by 18.3%, Meta advertising by 18.2%, and Google search and others by 14.7%. Now, if we go back here on fiscal.ai, we can actually look at the advertising business, look at the year-over-year growth rates. Again, over the last 12 months, this is a business that generates $61.2 billion in revenue, growing 19%. I mean, I think they can continue to grow 19-20% or so for the next 10 years. This is, of course, high margin business. Looking at the other business, the subscription services one, this is a $46.7 billion business over the last 12 months, growing low double digits, in this case, 11%. Can it continue to grow 10-11% or so for the foreseeable future? I think it can. So if you just take advertising and the subscription business, you already have an over $100 billion business over the last 12 months, growing double digits. What type of multiple do you want to put on that, right? It's quite incredible what kind of businesses Amazon owns. And we are just always talking about either AWS or some people just think it's just Amazon.com. But Amazon as a business has tremendous value with these sub-businesses. Then moving on to the why has it underperformed and why will it outperform in the future. First up, let's have a look here at EV to operating cash flow to actually see how profitable the core business is, or the pricing of the core business. Right now, we're seeing trailing EV to operating cash flow, 19.9. The average of the past 10 years was 27 times. If we look at the forward one, that's 15.1. The average over the past 10 years, 19.5. So, of course, you're paying less today than you were before, because today I do think that the business is, of course, better than before. And we can see this right here, free cash flow compared to operating income. Look at the huge difference right now. Huge difference between operating income and free cash flow. Look at what has happened with free cash flow over the last 12 months. That is, we have reached a peak here of close to $50 billion in free cash flow. Since then, that number has come down. Of course, we also know what has happened in the meantime. CapEx has continued to increase. Last quarter of the last 12 months, that's over $108 billion in CapEx. I don't see this number becoming much smaller anytime soon. But yeah, the increase in CapEx, I do think that the increase is going to slow down a bit. And once CapEx starts to slow down, we should start to see how profitable the core business is going to be. The current projections are like this when you look at free cash flow. For fiscal 25, $23.8 billion. Then that jumps to $53.1 billion in fiscal 26, and then another 59% year-over-year growth in fiscal 27 to reach $84.6 billion in free cash flow. If we look at operating margin for the business, again here, last 12 months, we can see the huge improvement over the last 3 years. We went from 2.7% back in Q4 2022, Q1 2023 to now 11.4%. Now, as for the non-scientific part of the video, this is net income growth over the last couple of years, and this is the price of Amazon stock and net income. As you can see, it does follow net income. And lastly here, and I do think that this will change, this is the total shares outstanding. Over the past 10 years, we have seen it increase by around 1.3% compounded. So sometimes it grows 1%, sometimes 2%. Amazon is one of the only ones, I think, with Tesla that does not buy back its own shares. For now, Amazon is one of those businesses that they grow, but they continue to invest aggressively to make the business better, bigger, and stronger. But at one point, yes, at one point, I do think that this business will just be so profitable that they will start to buy back shares. This is also one of the reasons why we have seen Amazon probably underperform over the past couple of years. But I do think that that will change in the future as this company will just generate an insane amount of free cash flow. We are going to see the stock outperform over the next 5 years, or at least that's my prediction. Last two things here. One, today you're paying $0 on their version of autonomous vehicles. In this case, it's Zoox. I do think that in the future, you're going to see these types of vehicles, probably some fleets of them in resorts, hotels, especially they're already testing it out in Vegas, but I do see this format of an autonomous vehicle in resorts, in smaller communities, maybe colleges, schools. Maybe this is going to be also a type of delivery vehicle in the future, autonomous delivery vehicles. Maybe they're going to do this with their own vans, with Rivian, who knows? But currently you're paying, of course, in my opinion, $0 for this business. Another huge business is this. You might say, what the heck is this? Is this a video game? No. Robotics, small robots, huge fleets of those actually. In June, Amazon told us that they're launching a new AI foundation model to power its robotic fleet and deploys its millionth robot. Okay, Amazon, for some reason, everybody only talks about Tesla, Nvidia, and maybe the privately held companies as robotics plays. But Amazon is the robotics play. Amazon, Google is a robotics play, as I've shown you with the Gemini model that was released or that was shown more recently. But Amazon has over 1 million robots. Of course, we're not talking about humanoid robots, but we're talking about these types of robots. Why is it such a big deal? Again, when we talk about the profitability and the scale of this business, having autonomous robots run 24/7, do tasks today that they couldn't do before, or even if they have slight improvements from a profitability standpoint, from an efficiency standpoint, this is huge for a business like Amazon. And so they say it right here. We're also introducing a new generative AI foundation model we've designed to make our entire fleets of robots smarter and more efficient, called Deep Fleet. This AI technology will coordinate the movement of robots across our fulfillment network, improving the travel time of our robotic fleet by 10% and enabling us to deliver packages to consumers faster at lower cost. Again, this might not seem a lot, 10%, but when you look at the scale of Amazon's business, 10% is very, very big. And so do not sleep on Amazon as a robotics play. Last thing here, we do have an analyst note on Amazon from Mizuho. Outperform rating, price target $300. The upside here is 35% based on the current price of the stock. The key takeaways are AWS growth expected to be 22% or more in 2026 versus the consensus number of just 20% growth. Anthropic is scaling compute demand, which will support AWS acceleration, Gen AI proliferation to boost inference-driven compute demand, and North America retail growth seems slightly overstated, but AWS plus retail margin gains are more critical. Basically, the story is AWS growth reacceleration. Right now, when we look at the stock, we are here below the 50-day moving average, but over the 100 and the 200-day moving average. RSI is pretty neutral right now. It did reach here a peak at around $248 or so. Amazon is expected to report its next quarterly figures at the end of October. That's the estimated date at the moment. So this is it about Amazon, why it has underperformed the market in the past, and why I think it will outperform the market in the future, why it remains one of my favorite companies to own. This is it. Share your thoughts down in the comment section below. Hit all the buttons, check out fiscal.ai down in the description in the pinned comment, and I'll see you all in the next one. Bye bye.